All right, good morning. This is David from Trader Dale's, and today I am going to go over a trade that we did yesterday. Okay, and I'm going to really mainly go over how we got the bias for that trade more than the actual execution. And the bias is going to be based on candle range theory, candle science, whatever it's called these days. It's the analyzation of candles in higher time frames and using them together to create, a bias. Okay, every candle on this screen, regardless of the time frame, is going to tell you a story. Every candle's got a body. Every candle's got a wick on the upside and the downside, and how long those bodies are, what color those bodies are they bullish or bearish? How long are those wicks on each side? All come into play to give you an idea of where price action is. So candle range theory is based on one simple concept. And that concept is that every single candle, taking any candle, let's take this long black candle because that's what we're going to use, is a range. Okay. And above the highs and the lows of that range, okay, is liquidity. Okay. It's also areas where market makers, okay, will search for higher prices, will price discover above and below. And the theory is that if price fails to discover new prices below and comes back into the range, that price will typically target the other side of the range. Very simple. Okay. One of the issues that plagues this kind of theory in what you see in YouTube and the way people teach it is the concept of it is very sound, but unless you're using it with point of interest context, meaning if your CRT model is not delivering from a key area, like a high volume area with a volume profile, a key pivot high or low on a longer term chart, 4 hour or daily, a higher time frame fair value gap, an hour, 4 hour, a daily, maybe a weekly. Yesterday was actually a monthly. Okay. If you're not delivering from a key area and that these patterns are not happening at key spots for reversals, then they don't mean anything. Then you're just a pattern trader. So let's go through yesterday, the progression. I have up here the NASDAQ from yesterday. I got a 15-minute chart, 30-minute chart, and an hourly chart. Okay. Now, the 15-minute CRT model, we will only really use in the first half hour, 45 minutes of the market where things are moving quickly. That's where you have a bias where the market is developing liquidity on both sides of the market, pre-market, and things move pretty quickly. A lot of times these 15 minutes will be very valuable. But when you do have a big move in the market and that move really lasts past 10 o'clock into 10:15 and you have a big candle like here, then we want to really look at the 30 and the 1 hour, okay, more closely to get our bias. So let me kind of show you. So down here, it's not shown. I mean, I'll just put a line here. We did have a key area that we tapped into. It was a point of control, very high volume area, okay, from a previous level on the way higher, okay, and we dipped into a monthly fair value gap and we attacked this POC. So this was a prime area for price to reverse from. Okay, I don't remember the exact value, but it was kind of around here. Okay, so again, when the market is making a huge move down, we're really not looking for 15-minute CRTs. But sometimes the early part of the move and the bottoming can, okay, start on the 15-minute. So if you look at yesterday, okay, at 10:15 to 10:30, we swept the low of this candle and then closed very strong. Okay, so what is that going to do? It's showing a bottoming pattern, and it shows the likelihood that we are going to trade into the top of that 15-minute previous candle. Okay, but we're not really going to act on that. You could, and actually it did work out, but we're going to wait longer, okay, because of the severity of the move. So now we go to the half an hour, and 15 minutes later, okay, the half hour chart closes. Okay. Well, actually, I'm sorry. The 30-minute and the 15-minute actually closed at the same time at 10:30 here, both creating CRTs. Okay. The 15-minute was here. Okay. And the 30-minute CRT was all the way up here at this level, this candle. Okay. So what the plan is now is to look for a retracement in the next candle and look for a shorter term entry to now take to that target. So now we have a bias. We have a bullish bias, we have a target, and we have an entry. Now, this 30-minute left a huge fair value gap. So typically when this happens, I'm going to want more confirmation from the 1 hour. If there was no fair value gap here created and we had a clean target to that high, then I'm all over this, okay? But a half an hour later, the 1 hour finally closed, okay, at 11 o'clock, okay? So, and it created a CRT model. So now the 15-minute already confirmed that we were bottoming. The 30-minute doubled that confirmation. And then the 1 hour really confirmed it. Okay, so now we are sitting here with a 1 hour model and we have two targets. Okay, we now have the 30-minute candle up there. Okay, and we now have a target, a main target of the 1 hour high right there. So on this candle right here, when the market makes a wick, the 1 hour candle that starts at 11 makes the wick. Because remember, you already have a bias. Okay, you have a bullish bias. You have a narrative. Where am I delivering from? A high-end POC and a monthly fair value gap. Do we have a target? Yes. Now we need an execution. And typically what will happen on these 1 hour candles, that price will dip, make the wick, it'll accumulate, it'll manipulate, and it will distribute on a 1 minute chart. And that's where you're looking to enter. Okay, you're going to go break even once you start crossing that high right there. And then you're going to target the 30-minute and then likely the 1 hour top of the candle right there. Okay, this is a candle range theory methodology, but based coming from a higher time frame point of control. Since yesterday was such a big move on the opening, we're using a combination of really a 30-minute and a 1 hour, okay, CRT model to trade to our target. And it's all based on the severity of the move, and it's all based on what fair value is left on the side. If there's no fair value that is left, then you can execute on shorter time frames. But the 15-minute is going to be more active and more likely pretty much on the first 15, 20 minutes of trading, maybe half an hour. Then the 30-minute and the 1 hour are going to come more into play. Okay, start looking for these patterns, start using them, start backtesting them. It's very easy to backtest. Go on the hourly charts, the half-hour charts. You know, you could place a screen right up here. We have all the ones right here. And you're looking for these to happen sometime in the New York session between 9 and really midday, 12 p.m. After that, everything kind of gets a little bit choppy. Okay, this is how we use and create a bias intraday, okay, based on the high value point of controls and the high points of interest that we use. And then our entry models here, everything is combined because remember, to have a trade, you need a bias. Where are we going? We need a narrative. If when we're going to get there, where are we going to get there from? Okay, and then we need a target, and then we need an entry model. So there are 4 pieces to every trade. Okay, the CRT model gives us help with our bias from an already determined levels of interest that we have already looked at from the higher time frame charts. Okay.
Hey everyone, it's Dale here. I hope you enjoyed the video. If you like to trade alongside me and our team of prop firm funded traders every day, then click the link below the video and hop aboard. We are looking forward to trading with you.